Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Laurel, Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Josh Knoll here. I'm joined by regular fill-in co-host, Mr. Jay Stubbs with Providence Partners. Jay, how you doing, buddy?
Josh, I'm doing great. It's Masters Week. We just finished up the NCAA basketball tournaments, men's and women's. Those were exciting. But there's a lot more excitement going on. We can have all the sports enthusiasts in the world, but gosh, there's a lot going on in the market.
Yeah, poor Florida. They may be the fastest forgotten NCAA tournament champion of all time with all the news we have going on. Well, we're going to get to that. Listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you. First segment, deep dive on our topic of the day. Second segment, roughly 25 to 30 minutes past the hour. That will be headlines of the week, and we got some doozies. Then roughly 45 to 50 minutes past the hour. Stick around for our third segment. We call it Joshua's Crystal Ball and Big Mouth. We have a little bit of fun with some predictions, and we got a really recent prediction I've got to go over with you, Jay. You'll like it. All right, quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, do not worry. Get a pen and pad ready. We'll repeat it several times throughout the show. All right, so Jay, speaking of news, I'd say that any investors tuning in that just love stock market volatility, well, that was a lot of fun, right?
Absolutely, Josh. I mean, we went from last week and the uncertainty with the tariffs and the announcements from the current administration, all in an effort to be fair to the United States. Really, they're just, that's what their administration is saying. Hey, we've done enough for the last several years. It's time for other countries to pay their fair share. And the current administration and Trump and his team have said that the way we do that is tariffs. So that went in last week, and for the last month. Last week we saw the turmoil in the markets, and then we get to this week when he actually announces what's going to happen. And goodness gracious, then a complete reversal. Yesterday when he said, "Oh, we're just going to pause it." Such an up and down seesaw. He created the administration and their decisions are doing things what they think is best for the country. The market reacted oddly. It reacted in what we all think was expectedly, but the numbers were so big. Yesterday's increase in the Dow was the largest single day gain in that index since World War II.
Wow. Well, you and our previous co-host last episode, John Luke Tyner of Aptus, you all were a little more optimistic about the tariffs and the reason behind them, but we're going to talk about some of my thoughts specifically around tariffs in the third segment of the show, so listeners stay tuned. For this, what I'd like to get back to, you just mentioned it. We're recording this on Thursday, April 10th. We're less than 24 hours removed from the largest single day rise in the overall stock market valuation. So you're right about the Dow, but if you took all of the indexes together, we've never had that kind of movement. And of course, we're recording this right smack dab in the midst of another 2 to 3% sell-off.
Another plunge.
Right.
I mean, this is like being in the playground, and your smaller statured friend is on one end of the seesaw, and your larger statured friend is on the other seesaw end, and they're just going up and down, adding friends to it, and just keep going up and down, up and down. So for those with significant assets in the equity marketplace, it's got to be a little bit gut-wrenching, especially for those who might be near or in retirement years. So we'll talk about that too.
That's right. Yeah. Last episode, John, Luke, and I discussed the reasons for the volatility, which I think most people understand. This episode, you and I are going to talk about what to do about it. Particularly, we're going to focus on you investors that may not have the stomach for this roller coaster that we've been discussing. All right. So first, let me set the table. I want to explain how Gulf Coast Financial Advisors is structured quickly. Okay, Jay, we have the fee for service advisory side of the business, where we manage clients' investments in a fee-only advisory accounts. Typically speaking, we use Charles Schwab as custodian, but we are custodial agnostic. We also provide financial planning services, wealth management services, retirement planning, et cetera, et cetera. We also coordinate with our strategic attorney and CPA consultants for estate planning and tax planning. And then in addition to those two levels of services, we have strategic partnerships, such as the one that we have with you, Jay Stubbs, and Providence Partners, specifically around risk management services, such as life insurance, disability income insurance, long-term care insurance, and income annuities. So on our fee-only investment management side, as I close this explanation out, we do our work through with Aptus Capital Advisors, where we do a lot of hedging on the equity side to help limit the downside of our clients' portfolios, plus hopefully potentially provide some additional capital when buying opportunities appear. I don't want to go too far down that discussion path today, Jay. Listeners, if you want to hear more about that, just go to our website, gulfcoastfa.com, go to the podcast tab, and look for Coasting and Retirement episodes featuring J.D. Gardner or John Luke Tyner of Aptus Capital Advisors. Here's what I want to talk about today.
Well, I want to echo what.
Yep.
So in other words, when those listening, whether they're in their car driving or around the house listening, when there's volatility in the stock market like we're seeing, and you think about maybe your client's 401k plan, their IRAs, their non-qualified investments, their education funding, maybe through 529 plans. When we see this volatility like we've had over the last couple of days and week, what I'm hearing you say, Josh, is there's a system in place that gives your clients the opportunity to maybe, make use of some cash that might be on the sidelines in this down, and when there's a down day or a down couple of days, and when others might be looking for the exit door, you got strategies where a client may say, you know what, I'm okay, my time horizon's good, I'm going to put a little bit in here and get things at a discount. Or you're also giving them a system that gives them a little bit of peace of mind because they feel like they're not as exposed to the ups and downs of the equity market.
That is correct. Specifically, Jay, around anything on an advisory account, generally speaking with Schwab, non-qualified or qualified money retirement accounts, you're 100% correct. But again, so that's not necessarily what I'm here to talk about today. Thank you for that little introduction, though. What I want to hear today is I want to discuss options with you for those of you listening, for you listeners that are tired of holding your breath every time you check your investments, especially those of you that check your accounts often. You know who you are. And here, listen, folks, I get it. It can be unnerving, even what Jay just said with how we set up our clients' investment accounts on the advisory side. There's still going to be ups and downs. I mean, I would love to tell you that I protected all my clients from loss this week, Jay. No, that's not the case. Now it's not a loss until you sell.
That's right.
But you're still seeing the account value decrease. Not perfectly in tune with the market. That's the part of the hedging. But again, you're still seeing volatility, and it can be unnerving to see so many ups and downs, especially when you feel like in this particular case, I do think people feel a little bit powerless about anything they can do about it, right?
Yeah.
So with all that said, let's start with this, Jay. You work with dozens of advisors along the Gulf Coast, correct?
That is correct.
Right?
Well, more than dozens.
It's hundreds at this point.
26 years, it's probably hundreds and hundreds, if not nearing 1,000 different types of agents and advisors with many different types of institutions, whether they are investment firms or banks or what have you. But yes, currently today, 2025, I have a roughly a network of 100 plus agents, advisors like yourself,
right.
that lean on Providence Partners in partnership to complement their wealth management firms, their property and casualty businesses, or just a great value-added resource for them when it comes to risk management tools and products and solutions.
Well, so what type, are you getting any kind of feedback from this broad spectrum around this recent stock market gyrations?
So I do a lot of reading and like you do, and snippets and everything else. And what I also have is a network of friends who have dollars invested, and some are older than me, some are younger than me. There's still a lot of people who are okay with what's going on, the volatility. Now I'm 48 years old. I think I'm 48 years old. So what we've got is a situation where I have another 20 plus years, Josh.
Yeah, we've got time horizon.
There's a lot of people who don't have
Correct.
that time horizon, and
Right.
that if I can certainly understand the uneasiness or the skepticism they may have when they look on their custodial accounts at logging in and looking at Charles Schwab, and they see red and they see unrealized. Now I want to point out that key word, unrealized.
Right.
They see unrealized loss, and that's a larger number, a larger percentage. Just keep in mind, like you said just a few minutes ago, unrealized meaning you haven't made a loss or had experienced a loss in your portfolio or your position until you've actually told Josh to get out of that position, sell your position. So that's something to be, for people to understand, is we got to monitor the volatility. And at some point, they'll either tell you, Josh, or tell us, or any of our other advisors that we work with, I'm tired, I'm done, I'm out. And we've had that experience.
You've been hearing that this week.
I've heard that from at least one advisor who came in and
Right.
said the client, after yesterday's huge gain, said, "Hey, I don't like the volatility. Let's take the position out of the equity market."
Right.
That's okay. The client was nearing retirement too, so certainly understandable.
Yeah, I mean, again, this episode we're talking specifically for those of you that are just not totally comfortable with the amount of volatility, because the word historical gets overused, right, Jay? But it's not being overused with this current stock market. This is historical levels of volatility. It just is. Now, again, on the investment management side, we have a plan for volatility, and the things that Jay and the products we're going to discuss, not only are they not necessarily a one size fits all, but it also, with any particular strategy, if Jay mentions for example, mentions a fixed index annuity, that doesn't mean that he's going to be recommending that you take your entire investment bucket and portfolio and put it all into one product. That's not the point of this conversation. Sometimes, and I will be open and honest with you, Jay, some of my competition will use the line, hey, we can take a certain product and carve a little bit of your investment portfolio out, and that'll be our quote unquote, safe play. And that allows us to take a little more risk on the other part of the portfolio. I'm not saying I necessarily agree or disagree with that. I can just tell you that when you go through 4,000 point swings in the matter of 48 hours, I'm willing to have a little bit more open mind about that conversation, right?
Wouldn't we all?
Right.
Yeah.
So let's do this. Let's discuss some product solutions specifically designed to help investors that are in this mindset extract themselves from this volatile market, or for those of them that Jay just mentioned that are on the tipping point of retirement or in retirement. Are there products that allow you to take some gains off the table and maybe, one, allow you to maybe take a little more risk in some of the other part of your portfolio, or for some people, if it's appropriate, produce lifetime income? That's a broad layout there, Jay, but I know you can handle it. Let's start there.
Well, the first is going to be cash reserves. That's one place you can park, certainly short term. I want to make sure that I have a good interest rate at the bank or whatever lending or banking platform that I'm using, but cash is a spot. The other obviously could look at the bond market. We'll talk a little bit more of that bond market of why it seems to be a little unsettled. So you could put money in to bond ETFs or treasuries, but certainly need to keep into consideration our interest rate sensitivity and volatility to bond portfolio. So those are a couple of areas. And then another one is certainly the short-term CD at the bank. So just like cash, CDs are cash. So those are three that everybody normally thinks about. But obviously we have some insurance-based products that are in the annuity platform space, Josh. And so in the annuity world, there are two products that are a good fit when a client says, I want to take some cash out of the equity play, reposition it, get some sort of return, and I want it to be market competitive and better than my CD rates, and certainly better than maybe a bond rate or a bond return. And that's a multi-year guaranteed annuity. Okay. Also, the acronym in our industry is MYGA, MYGA. We have MYGAs down to 1 year, all the way up to 10 years. Most competitive rates are in the 3-year MYGAs right now. So you could look at a 3-year MYGA and approach mid 4 to 5% in a guaranteed 3-year product. The other annuity product that might be a good fit for a parking asset is called a fixed index annuity. You alluded to it just a little bit ago. It ties itself in performance to the market and different indices, but it has a 0% floor, meaning whatever asset you put into it is never going to go below what you actually put into it. So MYGAs, that's certainly a guaranteed rate of return backed by the insurance company that's offering that product, and we shop those weekly. The rates change weekly, and we always have a company or 2 or 3 that are in the top. And then the fixed index annuities with different strategies that you can choose from that allow your money to grow. But if we do have the volatility, if we have a down 6 months or a down 1 year period, we're not going to lose any of the dollars that we put into that fixed index annuity.
Okay, so I got a couple points there. One, you mentioned cash. I will say cash equivalent is a money market fund.
Right.
So I got 2 compare and contrast to bank offerings around this, Jay, very quickly. One, a bank will have what's called a money market account. Advisors like me will have what's called a money market fund. Very similar type of feel to them, although they're structured a little differently. But just for an example, Schwab right now has a money market fund, SWVXX. It's a 7-day float on the rate. It follows whatever the Fed is doing. It's paying 4.17. So that is a 24-hour liquidity, what's considered a cash equivalent.
And it fluctuates daily.
Yeah, well, it fluctuates every 7 days.
So weekly. It's a weekly fluctuating rate.
7-day float. And then you mentioned MYGAs. Would MYGAs be kind of a kissing cousin type of competitive product to a bank CD? Is that the easiest way to think about it?
That's the easiest way to think about it.
Right. Okay. And of course, bank CDs are FDIC insured. We'll make sure we put that out there. As MYGAs are insured by the claims paying ability of the insurance company.
That's right. And we only represent A-rated companies or better through our operation.
Right. Now, you mentioned fixed index annuities, and the basic premise there is you get a little bit of market participation up to whatever the cap rate is on the contract with a downside protection on the initial premium placed, right?
That's correct.
Okay.
So I like to say if the market hits a home run, your fixed index annuity return hits a triple. So the market hits a home run, you're getting a triple. That's the caps and the percentages of performance there that we have access to. If the market strikes out, the fixed index annuity is still on the playing field and gets a walk to first base. Right. They're still there because they have not lost any capital.
Okay. All right. So the 2 things that you just discussed with MYGAs and fixed index annuities, at the end of those particular contracts, there's going to be a cash value or a premium plus whatever the gains were that can be returned to the clients at that point. Right?
Yes, that's correct.
Right. And specifically with fixed index annuities, you often will see some type of income rider attached to that.
If the client is interested in modeling out an income stream at a certain point in the future.
Very good. Okay, so what I want to do then, Jay, as we start closing segment 1, is can you go on that tangent now, talk about what if you've got an investor that has done a good job of growing their portfolio over a number of years, and they feel maybe not just in disagreement with what Warren Buffett has demonstrated recently, that this is going to be the top of things for a while, and we would like to take this as I go into retirement and maybe produce a type of period of income or maybe a lifetime income. What's some options they have around there, specifically deferred annuities and Michelle's favorite, SPIAs, single premium immediate annuities. Her favorite because she just likes to say it, not that she necessarily wants to buy one.
So if we want to generate income either now or later, we have a couple of options within the annuity platform to look at. Now is Michelle's favorite, SPIA, single premium immediate annuity. I put in a lump sum amount today. I generate a specified period of time, guaranteed monthly income from that asset. I get a bump in the interest on the front end, knowing that the insurance company is going to give me that bump. Then I'll take that and divide that out by a number of years, sometimes 5, sometimes 10, what's called period certain. 10 years period certain says that I'm going to get at least this income back guaranteed for the next 10 years. And also if I die, period certain, my beneficiary keeps receiving that income. So that's generating income now. Interest rates are fairly decent right now. So if somebody needs income now, we can look at SPIAs. And then if they say, well, I want to go ahead and lock in some income later, there are products out there that will lock in higher income roll-up rates. That's the terminology in the industry. Those are called deferred income annuities, DIA, or we can use a traditional fixed indexed annuity and add an income rider. Lots of different companies, lots of different products. Don't want to get in the weeds on that, but if your clients, if those listening, Josh, needed to say, hey, if I wanted to generate exactly $6,300 in income starting at my age 67 and today I'm 57, how do I do that? Well, we can model that. We can model an exact dollar amount and give you that in an illustration, and it tells you exactly how much money you would need to put into a product to get there, whether it's a SPIA for immediate income. Imagine, I need this income to start next month, or a deferred or a fixed index with an income rider. We can say this is what it would look like in 10 years based on some growth projections.
All right. And then one more specific point before we transition to segment 2. While we're talking about SPIAs, can SPIAs be used in a Social Security maximization conversation?
They could.
Okay. And kind of walk through, like you and I used it one time. We had a guy retiring young, which was great. And as anybody that is in or near retirement knows, when you get your Social Security statement, your projections, there is a markable difference as you wait every single year. Right?
Correct.
And when we did his financial plan, it really benefited him because his wife was also young and retiring young. It really benefited them for the primary breadwinner, in this case, the husband, to wait until full Social Security age to start drawing. But they needed the income now because they're retiring young. So we did a 5-year SPIA, and we did that income gap. Do you see that? Is that a common thing, or is that just something, a unique one-off approach? Yeah,
well, it's a unique approach. All of your clients are unique approaches, right, Josh? I mean, you sit down with everybody and figure out what's important to them about their money, their goals, their retirement portfolio, their income, their bills. So when you do that and you sit down with somebody, they say, well, if we do this Social Security now, we're having a little bit of a shortfall. We've got some assets on the sidelines. You can say, well, we can make up that income and we can guarantee and lock that in if that's a plan you want to use. And certainly it works in that scenario.
Very good. All right, listeners, for those of you that would like to start the conversation around your own personal investing goals and retirement dreams, we encourage you to reach out to us. You can call us 251-327-2124 or find us on our website, gulfcoastfa.com. That's FA as in financial advisor.com. On our site, there's a blue button in the upper right-hand corner. Click that. That'll put a 15-minute introductory phone call on my calendar. Or for those of you all that like to do business in person, like I do, you can always schedule a no obligation, no pressure first meeting at any of our 3 convenient locations. We're in downtown Fairhope in the Portico building. We're in Orange Beach. We have an office in Orange Beach. It's just down the road from the wharf. Or here in Mobile, where we're recording today, off Dauphin Street and I-65. We'd love to meet you all in person. Folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money, particularly this week. Every week we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So join us after the break to hear Jay and I discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we include the links in our show transcript, which you can find on our website, gulfcoastfa.com. Just look under the podcast tab for that particular episode. All right, Jay, without further ado, let's get at it with headlines of the week. So I'm going to start here. I wanted to take an opportunity with this episode to expose our audience to some of the industry-facing news sources that advisors like you and me use, okay, as opposed to all public-facing.
Meaning listening to CNBC all day, every day?
You're right. I don't know about that. Whew, that sounds depressing. Now, for example, I am a daily reader of investmentnews.com, also Advisor Hub, and CityWire. Now, for retail investors, those may or may not be a whole lot of help. I will say that if you are interested in learning how our business works on the investment management side, those are great sites. You, Jay, you lean on a daily summary from an organization called, how you say it?
NAFA.
NAFA. I always want to say NAFA.
Yeah, two industry associations that I'm a member of. I'm a member of several, but two that put out news summary snippets each and every morning. One is from the Financial Planning Association. The acronym for that group is called FPA. And then the other one is called NAFA, which stands for National Association of Insurance and Financial Advisors. Those are national associations. They've been around a long time, and they advocate and support the different types of advisors and insurance professionals in and around the United States. So NAFA and FPA send me summaries and give me great insight into what's going on in the marketplace. Instead of having to go Google it or search for it in my web browser, I get a nice summary of snippets of articles, and I can click on the full article and read that link, and certainly gives me some insight into my industry. Yes. Well,
and I was telling my dad yesterday that I read a abnormal amount of news around finance. One, for the radio show, obviously in prep and all that. And two, I think it makes me a better advisor. But what has absolutely made it clear to me is if someone is getting their news from one source and that news is not written, whew, man, you're missing out on a lot of information.
Yeah.
I cannot recommend you all enough, not to get on a tangent here, but if you're only getting your news and it's on TV and it's from one source, you're just missing out on a lot of info around your money.
You certainly are.
So, but let's get back to thank you for forwarding your NAFA briefings. I pulled this article from there. It's from thinkadvisor.com. It's titled, "Instead of Timing the Market, Do This." So, Jay, let's discuss some of the common sense guidance in this piece. I want to make sure that we discuss the author's contention that retirees right now, this article just came out yesterday, may want to push their retirement plans further out this year in order to, quote, sit out this volatility. I'm dubious about that statement, but I'm willing to hear the conversation. Let's talk about it.
Well, I mean, it's a risk tolerance question. At the end of the day, and you have opportunities to use different strategies to figure out what somebody's risk tolerance is. Your risk tolerance in your 20s and 30s is a lot different than it is in your 50s and 60s and 70s. I can promise you that. Just ask anybody that's willing to climb a ladder to trim the vines. Anybody in their 20s and 30s is going to climb the ladder. Like, oh, good, I'm good. I've got good stability, and I'm pretty fit, and I exercise regularly. Don't ask even me today in my late 40s. Don't ask me to climb vines on a high ladder. My risk tolerance is extremely low when it comes to that.
So true.
So that's a funny analogy, but you got to think about what is your risk tolerance and what can you withstand. Do you expect to stop having regular W-2 or income from your job or your career in the near future? Are you going to be relying on Social Security income? Do you have other assets that you can fall back on and use? Emergency reserves, other non-qualified accounts that you can draw income from, life insurance cash value being one of them. Do you have inheritance that might need to be considered that's on the horizon? So lots of different things. But at the end of the day, when my retirement account is down and I have an unrealized loss or an unrealized gain for that matter, I still need to sit down with an advisor and make some decisions based on my risk tolerance after all of the data points are put on the table. How long are we going to be working? For how much longer? What about our spouse? How long are they working? What other assets can we pull from? When do we need to pull the Social Security trigger? What expenses do we have coming up? Are we in a bad health situation? All of these things need to be considered. So I can understand where this author would come out and say, hey, we need to push your retirement out another year or potentially longer because we want to see if we can stomach some of the volatility that's going on. Well, the reason we push a retirement out is because we're not getting to our number. If we're not getting to our number, then our risk tolerance is affecting that performance. And certainly we need to have that conversation.
Well, and so I would say this, in my line of work, Jay, I wear two primary hats. I wear a bunch of hats, but I wear two primary hats. One is investment management, which is historically what I would say the general public thinks guys like you and I do. Basically stare at 3 computer screens all day and buy and sell and watch the investments, right? So that's one hat. The other hat is the financial planning hat. And usually there's some intertwine there. All of my investment management clients are financial planning clients. Not all of my financial planning clients are necessarily investment management clients. Some of them, young doctors, don't necessarily have assets outside of work that need to be managed. Some folks have brokers that they've been with for years. We respect that relationship. We handle the financial planning piece. The point of that is one of the first things that we do with the financial planning conversation for somebody that's looking at retiring is do an income solve. We're going to do an income exercise to see, just like Jay mentioned, what sources of income do you have? What is your lifestyle? How does the math look? How does the math work? And I think this ties back into what you and I talked about in the opening segment, where it's not necessarily, hammer meets nail, so everything needs to be hammered. But sometimes there is an opportunity there to talk about income producing products, especially for somebody that is retiring. I would argue this with this author a little bit, Jay. Since COVID, it's been all volatile. So, if you wait around till the volatility's done, brother, you may be working another 5+ years.
Exactly.
Right. So if it's going to be like this, which it probably is, then what do we need to do to look at your unique situation?
Right.
So, all right. Very good. Well, next up, we have a recent article from Morgan Stanley. And I would say the article is very timely. It's called Top 5 Mistakes Investors Make in Volatile Markets. So I want to focus on a couple of those mistakes. First, being overly aggressive in an attempt to make up for previous losses or bad choices. As J.D. Gardner has said on the show a couple episodes ago, if you're down 50%, that means you got to make 100% return to get back to even par. Right?
And for those of you driving or listening around at the house, and you might have ventured into a casino at some point in your past.
Perfect.
And you're sitting at the blackjack table or the roulette wheel or whatever game that you fancy your pleasure, or even the slot machine. And you're like, oh, I just lost. I'll just put a little bit more and I'll win it back real quick. It doesn't happen like that.
That's right.
It never happens like that. And it certainly would not happen in the equity marketplace unless you're, studying the trading and the demographic, or the statistical, what do they call that? Analytical trading. And when you've got 50 screens on your desk,
you're right.
That's not you, Josh.
No,
we're not day traders. But there are people that can take advantage of it. But your everyday investor, retirement portfolio, non-qualified portfolio, that's not the kind of stuff that you say, let's double down. That's just not the right thing to do. Well,
and two, before we move over the other mistakes that investors make, a lot of times the things that people cling to, just like you said with gambling in the investment world, to make those outside returns, a lot of times you're going into a very high risk class asset. For example, crypto, I think, would come to mind. You think, well, if I just plow this money into this latest meme coin, I can make up my loss on my portfolio. And you know what? A broken clock is right twice a day, I think the saying. Every now and then you might hit on something like that. But for things that we do where we're trying to build your portfolio on concrete and not on sand, there's going to be these parts of the market and investment choices that we just simply don't bring to the table. Also, Jay, this article talks about panic selling. So panic selling, and then lastly, the last piece to talk about is going to cash and staying there too long. You mentioned cash in the last segment. So we talked about being overly aggressive. Let's talk about panic selling. If you were somebody that sold all their chips on Tuesday, how do you think you felt on Wednesday? It doesn't matter. What do you think? Like if you were really beat up and depressed about your investment account on Tuesday and you sold, and you missed the what'd you say?
The largest run up in single day since World War II. You'd be pretty mad.
I'm not trying to make fun of anybody listening because there's somebody listening that did exactly that, and I'm sorry, but it does make you feel worse. All right, what panic selling? What's your thoughts?
Certainly you need to avoid the panic sale, and that's the whole reason that the different custodial accounts, fiduciary accounts, the different types of statements, when you log in on your app on your phone, it says the word, we've already mentioned it today, unrealized.
Yes.
If you look at that number and say, okay, well, let's just keep an eye on it. Certainly if you need the cash in a short-term position, maybe 60, 90, 180 days out, maybe you do need to panic sell. But at the end of the day, I don't think it's good for any long-term horizon investor to take all the chips out of the marketplace. Now, let's talk about the other strategy of going into cash and staying into cash too long. One of the first things that I learned about when I got into this industry over 25 years ago is dollar cost averaging. So when we do have a downturn in the market, equity marketplace, we understand, okay, now is the time to buy or to reinvest some of our dollars that we have had sitting on the sidelines in a down market. But we don't do it all at once. We structure it over a 30-day period, a 60-day period. We take the amount of money. So Josh, hypothetically speaking, if I came to you and said, I've got $10,000 sitting on the sidelines, you would then come and say, let's dollar cost average that over the next 60 days. Mm-hmm. So every week we would take, that's going to be roughly 8 weeks. We would take that $10,000 and divide that by 8, and we would reposition that into our overall portfolio. And that's a very easy, trusted way to get back into the market in a depressed equity environment.
Yep. Yeah. I mean, the saying in our industry, Jay, is it's time in the market, not timing the market.
Right.
Now, common sense will tell you all, sometimes cash is king. We were poking fun. Hopefully you understand those of you all that actually did that. We're just trying to poke a little gentle fun on anybody that sold out Tuesday, because I get it. I mean, especially if you're, like Jay said, if you're way past if you're several years older than us and you're sitting there thinking, man, we may be entering into another Great Depression.
Yeah, like Fred Sanford. This is the big one.
This is the big one. I'm coming to see you. What was his wife's name?
I can't remember.
Oh, gosh. I love that show. I kind of grew up like that, to be honest with you, Jay. But anyway, so back to the point. If you were in that, thinking that, and you made that decision, we get it. On the flip side of that, if you were sitting there with cash yesterday, Tuesday, not a bad time.
That's right. I mean, by the way, her name is Elizabeth.
I'm coming to see you. I'm coming to see you, Elizabeth. I love it. All right. Well, it's so, listen, there's a reason we have a segment of the show called Josh's Crystal Ball, because it's to poke fun of the fact that I don't have a crystal ball and neither do you. So if anybody ever tells you that they can perfectly time the market, just, smile and walk away. Trust me on this. There's ways to put your portfolio. I mean, there's an opportunity cost that it ties into being in the market. And then again, not to toot our own specific horn, but what's the plan when the market does go down? Because you need to have your financial advisor and your financial planner needs to have some kind of plan, whether that plan is using some type of hedging on the advisory assets that you have, whether that plan is maybe having some of your capital locked up in something with a 0% floor, which is something that Jay Stubbs can help you with, or maybe it's something where you've taken those decades of gains, you've taken some of it off the table, and you've used that to produce guaranteed income every month. There's ways to go around this where you're not just sitting there with anxiety all the time, right? All right, very good. Next article, Jay. Our show opening, we discussed ways that investors can use insurance products that your organization, Providence Partners, can help them with to use insurance products such as annuities to help reduce volatility and potentially preserve capital. Now, annuities are not the only thing investors flee to in times of turbulence. There's also, you mentioned it earlier, Jay, there's bonds, there's government securities. I'm a little side note here. One of the reasons I do think that Trump decided to cave a little bit is usually when there is a flight to safety or flight to quality, what the article we're about to talk about, usually what you see is there's a corresponding flood to government securities, particularly the long-term treasury. That was not happening. And that is not a good sign.
That's right.
So if y'all want to go Nerdville on why he actually probably blinked, the fact that the normal correlation with a flight to safety was not happening had to be deeply concerning to a lot of the economists in his circle. And again, I have an economics degree, and I'm not by definition an economist, but I think like one. So let's talk about this. Let's talk about macroeconomic trends. I found this article on The Street. The Street, it's all one word. It's titled, "What is Flight to Quality in Investing? Definition and Impacts." I like a sentence in this article, Jay, I want to talk about. It's called, or the sentence is, "Flight to quality is a bit of a misnomer as lower risk asset classes aren't necessarily higher quality than higher risk investments." That's a very true statement. They're simply less volatile. So let's discuss. Flight to quality a lot of times is not necessarily a flight to higher quality, because a well-run advisory account, heck, even a real well-run brokerage account, doesn't necessarily mean that it will have more volatility than an annuity. It doesn't mean the annuity is a higher quality choice. It just means it's a less volatile choice. How do you go about that?
Well, I mean, volatility is one of those things that we manage, tie it into the risk tolerance. So if the risk tolerance score that you might give somebody is low, meaning they don't like risky stuff, you're going to put things in less volatile product positions or portfolios. But yes, there are certain situations where we have to stomach that volatility, and I get it, I understand it. And so, like you just mentioned, everybody thought, oh, well, the flight to quality here, or the flight to less volatility, is going to be in the Treasury yields. Well, that didn't really happen as much.
That was very discerning on a global scale. Yes.
And so the tariff pause, and they ended up having a successful auction of $39 billion in 10-year notes yesterday that helped with the bond market. But it was one of they said it was one of those fire sale of the treasuries. Volatility has a direct correlation to your risk tolerance. So you would tell Josh or any other advisor, my risk tolerance is low. I need to be in less volatile stuff, things that don't swing as much as they should. And there's a volatility index that's out there that you can actually track, and you can manage and have a portfolio that's tied to that. I think it's what the VIX is.
It is, yeah. It's the fear index is how it's loosely referred to, and it's been pegging at crazy numbers.
Yeah.
Right. And on that note, Jay, so most people on the risk tolerance will say, a lot of people will say, well, I want to make money, but I don't want to lose any money. And here's the thing. I'm going to pick on the competition just a little bit before we go to our last article. But you could take that statement and use it to your advantage as a producer in our industry. And, there'd be an argument whether you did the client totally right or wrong. That's an argument for another day. My position has always been, and I think Jay is in complete agreement, is let's take that statement and let's flesh it out, and let's figure out, not that we're therapists by any degree, but our job is to help you understand why you feel that way, and to help educate you on the different options, to where maybe at the end of the meetings, or the meeting or meetings, you might have a better understanding of, yes, volatility is something that can be very uncomfortable, and there may be a reason to take some of your portfolio and extract it from that volatile mix. But also, volatility is an opportunity over the long term to potentially get things at a long-term discount. It's a bigger conversation, is the point, is what I'm trying to make.
Absolutely, bigger conversation.
Very good. All right, last article, and it's actually a flow chart. We went to your website, providencepartners.org. So Providence, common spelling, partners with an S.org. And you have a resource tab, which is very helpful. There's no, you don't have to give them like your email or your social security number to get any of this information.
Yeah, it's no username, password, no paywall type of scenario.
Right.
It's just consumer friendly, advisor friendly resources.
Well, since we've been talking about, on this, we've been talking about some annuity options, I wanted to discuss your annuity decision flow chart, because some of the articles we talk about are very detailed and take 10 to 15 minutes to read. This is something that somebody can look at and have an understanding of it within a couple minutes. So I'll leave the floor to you on the annuity decision tree chart.
So we talked about annuities earlier in the show. There's the fixed annuity, is the broad spectrum of the product that MYGAs fall into, income annuities fall into and fixed indexed annuities fall into.
There's a fixed component of some sort inherent in that annuity contract.
Correct. And the insurance companies that we represent, this is the other side of the house for the life insurance company, is the annuity side of the house. So they offer fixed annuities, and they're also in the marketplace. There are products called variable annuities. We're not talking about those.
Right.
Those are up and down swings, volatile, retirement planning products. They are in the marketplace. If you have an old variable annuity, you need to let Josh review it. But a fixed annuity decision tree says we have an income, a wealth that we want to transfer to the next generation, or we have growth and accumulation of our asset. We just simply look at each of these three and determine where we are. Do we want income? Do we want to transfer the wealth, or do we want to grow the wealth? Then if we've decided on income, then we make a decision. Do we want that now, or do we want it later? Earlier in the show, we talked about SPIA, single premium immediate annuity, immediate income now, and then DIAs, deferred income annuities, deferring the income until a later point in time. In the wealth transfer world, we simply say we want to make sure that our asset is going to transfer to our children, grandchildren in a seamless manner. We can do that with a beneficiary designation, and sometimes we can get a little bit more money for a death benefit than what we actually put into it. Let me have everybody understand, that is not a life insurance product.
Right.
That is an annuity product that you can use for transfer of wealth. You can protect against potentially long-term care events. So it's always good to understand that component of a fixed annuity is a transfer product. And then lastly is the accumulation strategies. That's where we look at MIGAs, multi-year guaranteed annuities, and then fixed index annuities, really just dependent upon the time frame that we want to leave that asset working for us. And we look at anything from 3 to 10 years, nothing more usually than 10 years.
All right, folks, again, you can find that chart on Providence Partners under the resource tab. Look for the annuity decision tree. Very good. Well, listeners, I hope you learned something from our discussion around these recent financial headlines. All of it, we would argue, matters to your money. Speaking of money, if you would like to start the conversation with us about your investments and retirement planning, we encourage you to reach out to us. Give us a call, 251-327-2124, or visit the website, gulfcoastfa.com, FA as in financialadvisor.com. Upper right-hand corner, there's a blue button. Click on it. Set a 15-minute conversation on my calendar. If you want me to call you, make sure you include your phone number. Or better yet, just reach out to us to schedule an in-person conversation. Any of our three offices. That's downtown Fairhope. That's Orange Beach, right down the road from the wharf. Or Mobile, sitting here off I-65 and Dolphin Street. All right, folks, coming up next, Josh's Crystal Ball and Big Mouth. What have been some of my predictions? Have I ever been right? Was I ever wrong? Now, if I was, how wrong? What do I think is going to affect investors in the near future or maybe the distant future? We talk a little bit about these things, plus what Jay's opinion is, and we get to poke a little bit fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll, here alongside guest co-host Jay Stubbs of Providence Partners. So Jay and I are opinionated. We have strong opinions at times. I would always argue that a radio show host that isn't opinionated would be very boring to listen to. Jay and I are also paid in our profession, our respective professions, to offer professional guidance and opinions to our clients. Otherwise, I guess you just replace us with AI. So, make predictions, and I feel like I'm usually proved right. Sometimes I do swing and miss. Let's get at it with Joshua's Crystal Ball and Big Mouth. All right, Jay, I got two things. One is business, and I'm going to do quick with it. I made a prediction. I didn't do this on the radio per se. Actually, I did talk about it with John Luke Tyner of Aptus, but it definitely with some of my clients. My opinion was this, that Trump was going to blink on the tariffs sometime this week. My guess was Friday, but he did it quicker than I thought. And part of that was, folks, put some of the news to the side, especially news that you're watching. You're not getting the full story. If you want to just look at it from an unemotional economic viewpoint, I knew that at that point already there were rumblings that the flight to quality that you typically see when you see that much money coming out of the equity market was not happening, which is a very, very strong indication that there is more uncertainty going on, at least globally, than what the administration had actually anticipated around these tariffs. And that's why you saw the quick pivot on that. But that, what I just said, Jay, and you take that plus $2 and that'll get you a cheap cup of coffee at the gas station. Who cares? It is what it is now. And now we just got to deal with it. I think more importantly, as we're recording this, I'm very jealous because I've heard nothing but wonderful things about Augusta and the Masters. So let's open it up to you on predictions. We're recording this Thursday, the weekend before the Masters, correct?
That is right. I mean,
and it's going to come out Sunday and Monday.
And we're recording.
So who's going to win?
I'm going to go ahead and say here we're time stamping this.
That's all right. We have to. Everything's too relevant
through
right now.
12 holds. There is a 4 under par that is currently posted from a fellow that nobody's ever heard of.
Tiger Woods.
No. Stefan Jaeger.
Stefan Jaeger. That sounds like
He is currently 4 under through 12 holes. But right behind him, Scotty Scheffler.
Okay, that's the name I do recognize as a non-golfer.
He is on the second 9. He's starting on hole number 10 right now, and old Scotty Scheffler is 3 under. So if you want to make a prediction, everybody was kind of gung ho on Rory. We don't know where Rory's going to be through today into the weekend, but let's go ahead and say if Scotty Scheffler is tied for second halfway through round 1. I'm going to go ahead and say Scotty Scheffler is going to get his 4th green jacket, his 2nd in a row.
Impressive. Now, correct me if I'm wrong. Again, not non-golfer here, right? At the Masters, it's harder to make up strokes, right? Because it's a tough course, as opposed to a fast course where a guy can get 5-6 strokes down, and if the leader has a bad day, they can make it up quickly. The Masters is generally considered a pretty difficult, complex course. Am I right or wrong?
That it is one of the most difficult courses in the world.
Good for me. Points for me. Yeah, and I've heard it's unbelievably beautiful, and I've heard from people that I would consider not hardcore golf fans saying that when they went, they didn't want to leave. So
he's amazing. The golfers that are there are amazing. What they have done in the last 70 plus years with the Masters is they've turned it into this mecca.
And I think you're going to be there perfect weather from what it looks like.
Yeah, it will be beautiful.
So good for you. Follow Jay on social media. He'll be putting up a bunch of pictures.
Actually, no cameras and phones are allowed.
Oh, that's right. He'll be putting up pictures after. All right. Well, folks, I hope you enjoyed a little behind the scenes commentary on how Jay and I form our opinions, especially that we're willing to admit this time we're right. We'll see what Jay's Masters prediction comes out to be. If you want to start the conversation with us, why don't you give us a call? One last time, we invite you, 251-327-2124, or website, gulfcoastfa.com. Upper right-hand corner, blue button. Put a 15-minute introductory phone call on my calendar. It will be fun, I promise. You'll walk away. We always try to leave you better when we found you, one way or the other. Well, folks, that is it for this week. I want to give a huge thank you to my guest co-host again, Jay Stubbs. Thank you, buddy.
Absolutely.
Also, thank you very much for you sponsoring the show and your business, Providence Partners. Thank you to our longtime awesome radio station, that's FM Talk 106.5 out of Mobile. Also, thank you to our newer station, WHEP 92.5 FM and 1310 AM out of Foley. Many thanks to the provider of our show music, that's local band Sloth Racer. Thank you to our show producer, that's my son Peyton Null. He is a freshman year at Auburn, which they lost the Final Four. Too bad, make free throws. Always my sincere appreciation to all of you out there that have been listening and joining us on this journey. We'd love to be part of your journey as well. Until we talk again next week, have a wonderful and productive time. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting and Retirement Radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.